Hello and welcome. You're watching KYC. Today we're going to try and analyze a very interesting bank. We're talking about J&K Bank. Now, this one has been a multi-bagger of sorts, over the last few years. It's especially piqued interest because suddenly the performance has seen a bit of a turnaround. Now, let me first take you through the return itself. It's given a 7-bagger return over the last 5 years. Stock price has gone from 13 rupees a share to 95 rupees a share, where it sits currently. Now, in terms of what I want to know, therefore, is there still value in a bank like a J&K Bank? Is it undervalued at this point? And of course, while we won't answer this directly, we'll probably try and get better perspective on whether this is actually the case, because even now, the bank trades at below 1 times price to book. So whether it's an interesting proposition at this point or not is something we'll look at. The other piece we'll really talk about is the impact of all the border tensions that have come across, and what is the impact of that on J&K Bank, what to expect with regard to everything that's playing out going forward as well. That will be the other piece we'll speak about. Is the best behind in terms of credit cost, and that has largely led the kind of outperformance that we've seen the bank produce. And therefore, is the best behind, or do we still have more in terms of performance or outperformance, which the bank can continue to try and generate? The last piece is with regard to return ratios. There's been significant turnaround in terms of return ratios. Your ROAs are now closer to 1.5%. Can that kind of ROA number sustain is then my final and last question. And we'll try to therefore contextualize this, go back and reassess. Let's first talk about what the bank has been up to and what it does essentially currently. It was incorporated in 1938. It serves retail, corporate, agri and MSME clients currently. It has around 1,012 branches. 874 of those, which is nearly 80% plus, are in J&K and Ladakh at this point. They did a fundraise, of course, in December 2023, but outside of that, the current focus areas of the bank, and we'll talk about the business mix as well that the bank has, but the focus areas is to boost CASA and cut funding cost and enhance asset quality, as well as reduce NPAs and grow non-interest income via treasury. So those are some of the key focus areas at this point for J&K Bank. Now, in terms of how the loan mix is, and this again is something which is very interesting. 40% of the loan mix is personal loans. Trade and services is the other large piece, which is around 21%. As I did mention, a lot of it is MSME loans as well, and some of that reflecting in these metrics. Manufacturing is the other one, 7%, 10% each for agri as well as financial markets, and then you have 12%, which is others. That's how the loan mix is, so fairly diversified in that sense, despite it being promoted by the J&K government, and therefore to a large extent, it is a very localized bank. But despite that, you're seeing a wide array in terms of its loan mix disbursement. Let's right away start. Okay, so thereafter we'll speak with the management. We have Mr. Amitava Chatterjee, who I spoke with, who's the MD CEO at J&K Bank, and tried to contextualize some of the key reasons why we're doing this for KYC. So we'll have that conversation play out as well. But let's first start off with the metrics that we're going to look at when it comes to J&K Bank. We look at income statement. We look at balance sheet, how healthy the growth has been. We look at operational metrics, as we always do with all banks. We look at margins, spreads. We look at credit costs, etc. We look at asset quality thereafter. We look at return ratios, shareholding, street cred, and valuation. And thereafter, hopefully contextualize and put all of this together by speaking with the management and getting better perspective on what to do at this point with regard to a J&K Bank. Let's first start off with the income statement though. With regard to the income statement, it's been an okay-ish top line growth, 14% last 3 years. But really what's essential is to look at the bottom line therefore. Look at the way in which profitability has gone up. It's gone up by 61% CAGR from FY22 to FY25. Two reasons for that. First reason is your operating profit has gone up by 39% over the last 3 years or so. So that's the first key reason. Your operating profit, the key lever for that has been operating expenses, which have gone up by just 6%, despite net interest income going up 14%. A large part of that 6% is back-ended, which is that it was done more closer to FY25, and therefore the growth clip was extremely strong when it comes to the operating profit growth. So 39% growth in operating profit. That's one lever why profit after tax has gone up. And if we can change the graphic and look at provisioning as well, look at the way in which provisioning has come down. So your credit costs have actually come off quite sharply, right? So from FY22 at 360 crore, it's come down to 74 crore, gone negative because there were recoveries which were at play. So 100 crore of recovery net in FY24. Even FY25, there's a net of 4 crore in terms of recovery. And therefore, where does FY26 lie is the key question with regard to this number. So we'll have to look out for that. But two of these levers really playing well when it comes to profit after tax growth. Roughly 400 crore contributed versus FY22 just on the provisions front. And then you had a stronger growth clip of almost, if we turn back and look at the income statement, your net interest income has gone up by roughly 1,900 crore. So that number plus the reversal in provisions added a chunky amount to the profit after tax number, given that OPEX didn't go up significantly during the same period. And your cost to income ratio has also come down. We'll look at that number as well. But definitely a thumbs up with regard to how the income statement has shaped up. Now let's look at the balance sheet. This is where some disappointment starts to creep in. Look at the loan growth. In terms of overall gross advances, we were at 75,000 crores, so not a very large book, right, in FY22. FY25, we are just at 1,06,000 crores, so no significant growth in the last 3 years, just about 12.5%. And it's been a period of very high growth for the system as a whole. Plus, this is a smaller bank with a smaller base. But this kind of underlines the linkages the bank has to J&K. And therefore, a lot of the growth is governed by how growth in J&K does. But we will look at this independent of that, because this is a bank and it's one option in a larger portfolio versus buying another bank, which could be another option in the larger portfolio. So it's this versus that. And therefore, 12.5% doesn't really excite us. Deposit growth also just about 9%. CASA growth is also very, very average at 2.5% compounded. So therefore, you're not seeing substantial growth come in, at least on the balance sheet. Capital adequacy remains fairly healthy at around 16.5%. So that is okay. That can take care of growth at this point. But you want to look at better growth, right? So that's what we're looking at where the balance sheet is concerned. Let's look at key ratios very quickly. Yield on loan, largely just about a 60 basis point increase over the last 2 years rather, FY23 to FY25. Cost of deposits also have gone up, but that's also because of the way in which we've seen pressure on the deposit side of things. Margins have again stayed steady state. So strong with regard to margins. Cost to income has come off sharply, and ROAs therefore have expanded closer to the 1.4% mark. 1.3% is the full year ROA. Let's look at the current financial year as well. Yield on advances 9.6% to 9.4%, so very little variation in that. Cost of deposits largely flat as well. Margins staying in that 3.85 to 4% kind of band. Cost to income has been fairly measured in that sense, 54, 55 odd percent. So it's come off from those 60 plus percent, 65 plus percent levels in FY23, which we had seen earlier. And ROAs are roughly between 1.3 to 1.45%. The latest quarter, of course, ROA was 1.45%. So that's how it's shaped up. We'll give this a neutral because you want to wait and watch the sustainability of some of these metrics. Let's look at asset quality. Asset quality has gotten better, but if you look at the NPA ratios earlier, 6% NPA, it's come down to 3.5 odd percent. But can it go back to 6? Well, it's likely, and therefore you want to be cautious about this because it's come out of a high NPA cycle. NPAs are coming off slowly and steadily. Your net NPA ratios also have somewhere started to stagnate at that 0.9 to 0.8% number. When you look at the last 3 quarters of net NPAs as well, can we quickly pull that up? You'll see 0.85, 0.94, 0.79. That's how it's going up and down. It's fluctuating a bit. So you want to wait and watch and see whether these numbers are sustainable or not. So that's on the asset quality side of things. Now, let's look at return ratios. And return ratios have inched upwards. So they've inched up from that sub 10 or 6.5% mark to 16% in the last 3 years. But there are one-offs. We've spoken about this, that the income statement reflected some one-offs. And due to that, you've seen a significant increase with regard to ROE. Again, what you want to see is, can this sudden jump in ROE sustain? They've done fundraisers, and therefore, could ROEs well taper? Well, we'll have to wait and watch. But for now, we'll keep that 16% ROE in mind. It's been a significantly healthy performance. Sustenance is going to hold the key, which is why we are giving this one a neutral as well. Now, let's look at shareholding pattern. Shareholding pattern is fairly steady in that sense. Government owns roughly 60% of the bank and has been largely steady. No further dilution mandated because you have certain PSU banks where a dilution is required to be done given that government ownership is significantly above 75%. Here, there's no mandate per se required, and therefore a further dilution is not required, will only be done as and when necessary. As and when growth kicks in significantly and capital adequacy shrinks, you might see some bit of dilution here. But promoters certainly not looking to sell, which is the government certainly not looking to sell at least this bank at this point. Also, given that it's critical with regard to J&K's infrastructure, very unlikely that they will sell, and therefore a clean thumbs up with regard to the shareholding pattern. There's decent amount of FII and DII interest as well, and public holds around 25 odd percent. Now let's look at street cred. In terms of the stock price performance, and we've spoken about the larger period, right, over the last 5 years. But let's look at the 1 month share price performance, up 6%, okay. You look at, and you zoom out a little bit to the 3, 6 and 12 months, it's not done as well. So we've already seen some bit of outperformance that's kicked through. Last 1 year returns have been very, very tough to come. And look at that last 1 year performance, 28% down. So you want to wait and watch as to what the shareholder who's been holding it for a year very, very patiently is going to do. It's down 30% from there. Street cred definitely not looking too bright from a near-term perspective, but from a longer-term perspective, it's been phenomenal. There's been a large re-rating that the bank has seen. And therefore, let's look at valuations now. Is it a good time to hold, buy or sell given valuations purely? You look at how the EPS has gone up, right? The incremental EPS outside of fundraising ensures that your book value per share currently sits at 111 rupees a share, right? At 111 rupees, you're seeing a price to book value on this of roughly 0.885 times, right? And therefore not looking altogether expensive. But mind you, the stock has corrected 28% from the highs. So from those higher levels, it's come off quite sharply. And the last 5-year price to book was just about 0.5, 0.6 times. You want to keep your eye out on both of those metrics because it's trading at a significant premium to 5-year averages, but also there's been a turnaround in the bank in the last 3 years. And therefore, that valuation bump up is warranted to some extent, and that's probably one way to look at it. Currently sitting at 96 rupees a share or 95 rupees a share, and the stock price or the book value per share is around 110. So that's how the journey has been made. Now let's go across, let's not delay. First off, let's try and wind up with regard to how it stacks up on our KYC rating. That's how we're seeing in terms of the thumbs ups and the neutrals. No significant thumbs down that we are seeing because we're continuously seeing improvement across metrics. We've noticed that all through this analysis, and we're continuously seeing improving metrics on that count. So we'll give this a 5.5 given all of the metrics that we've spoken about on our KYC rating. Now let's go across, listening to that conversation that I had with the management earlier today. We spoke with Mr. Amitava Chatterjee, who is the MD and CEO of J&K Bank, and here's what he had to say on the bank's growth trajectory in the years to come. What's his expectation, as well as all the risks that we've spoken about here. Listen in.
As far as the direct impact, if you ask me, the direct impact on the loans is very, very nominal because the total exposure the bank has on the tourism sector, including the hotels and the transport, is barely 1% of our total loan portfolio. So, and historically, we have had such situations in the past which have not affected the bank much. The stress were somewhere around 2 to 3% only of the tourism portfolio. So, I do not see much of a problem directly. As far as the indirect impact is concerned, yes, tourism is almost contributes 10% of the GDP of the state. So there would be other sectors which would be affected because of the situation because of the tourism mainly, because it has been affected since the incident. The bookings and visits by tourists have come down drastically. So it will take some time. We are also expecting the upcoming Amarnath Yatra to be successful to get back the tourists. That is one aspect. But yes, the indirect impact is yet to be assessed properly. Even if there is an impact, I don't think it will be much because in the past this has not affected the loan book. As far as deposits are concerned, the 88% of the retail deposit of this bank directly is from the this geography. So I don't think there would be much of a impact on the deposits because of our market share in this geography is almost close to 60%.
Okay. And sir, the journey towards diversification, especially on the loan book side of things, do you think that is in any case underway and that will in some form or shape insulate you from any impact per se? And what is the growth target going to be like maybe over the next year and over the next 3 years? Give us a short and then a medium term outlook with regard to where growth is.
Thank you. In fact, if you notice in the last quarter, the growth in the loan book has essentially come from the rest of India. So the bank acknowledges this fact that there is a concentration risk, and it is a very big opportunity, and the bank is placed in a very nice way in a sense that it is present in 20 other locations in the country. It's already present. I mean, we do not need to add on to that. So diversification is, of course, something that is in the mind, not because that the bank would stop any kind of lending or any kind of business activities in the region, because it is essentially meant for this UT. So that will continue. The support to the economy of Jammu and Kashmir will continue as it is. But of course, diversification from the point of view of mitigating the risk, the concentration risk will continue. So in the say next 1 year, I expect a growth of around 12%. Uh, in case the business as usual starts happening in this UT, then it will be more than that. So 12%, considering that there will be some moderated business activities in this state. In the long term, 3 years to 5 years, I expect a CAGR of close to 14 to 15%.
Point taken, sir. And deposit growth per se not a concern for you, given the fact that in any case your loan to deposit ratio is quite decent.
See, it is as big an issue as for any other bank in the country today.
Sure.
But what I have seen, the appetite for term deposits has gone up since the fluctuations started happening in the capital markets. So in the last quarter, we had a fair bit of deposit growth. And then again, we have an advantage of a pretty good CASA, although it has come down in the last couple of years. But we still have a CASA ratio of 47%, which does help us in many ways. And the deposit accrual in this state will continue as it is. The movement from deposit portfolio to the mutual fund or the capital markets is not that significant in this state. But yes, having a good CRAR at the moment, the advances growth will not be an issue at all.
Fair point. And sir, what about margins? It's a rate cutting cycle. Do you expect, and your CASA is extremely healthy, so to give you credit there, what's the impact like with regard to margins?
See, very few banks would have maintained the margins of 2024. We are one of the banks which has actually been able to do it. So, as you said, it is essentially because of a healthy CASA ratio. But then, having said that, we also expect a bit of a pressure on the margins going forward, because the rates have been cut to 50 bips and we also expect further rate cuts. So that will put a pressure on both the lending rates as well as the deposit rates. So I would be happy to have a CASA above 3.7 anytime. At the moment, it is close to 4%. I do not expect it to continue at 4%.
Okay. Understood. And so therefore, how much should we expect in terms of a CASA taper? Where will it bottom, and do you expect it to go back towards 4% in the medium term? Is that what the expectation would be?
See, we have our targets. This bank has been a little bit late in introducing technology. Now that we have done it, so I expect that is going to help us in CASA mobilization. We have set our targets. We intend to see, even CASA has grown this year. The ratio has gone down because of the increase in term deposits in a faster rate, higher rate. So we intend to take CASA back to as close to 50% as it is possible, because it used to be 50% some time back. So in case we can do that, then I think the pressure on margin will be lesser.
Okay. So your operating profit and your provisions is what is allowing very, very strong profit expansion at this point. Your operating profit on a 3-year CAGR basis has done 30+% in that sense. From roughly 1100 crore in FY22, it sits at 2028 or 2030 crore, 2930 crore, I beg your pardon, in FY25. Extremely strong growth. Can that kind of growth clip continue in your opinion, or will it now start to taper?
See, there is a huge potential, I just said. We are present across the country, so the growth in the other parts of the country, helping the interest income will be definitely there. We have not actually used that potential to the limits as of now. We have a huge potential there, and then we also have a huge potential as far as the income from treasury is concerned, forex and treasury. That has also not been exploited to the extent it should have been. So I do not see any reason why the operating income should come down. In fact, I would believe that it is likely to be better than what it is now.
Point taken. And so with regard to reversals, because that's been the trend over the last couple of years, your credit cost has been aided by reversals. Where should we see normalized credit cost? Because it's already started to normalize, right? So where should we see it normalize at?
Sir, this year you would see a normalized situation. We had substantial technical write-offs which we have been able to recover and improve, of course, both sides, the profits as well as the interest income out of that. So the reversals have happened because of the recoveries that have come from old NPAs, the aged NPAs. So that ratio is gradually coming down. So, but then I am very positive about the current position of our, likely NPAs. We have a very small amount of stress in the book, and traditionally this UT geography has had very low level of NPAs. So slippages would be much of it would be contained. So credit cost will not be. It would not be going to that level where it would be noticeable. But yes, as you said, it will slightly normalize from this year onwards.
Okay, so but that's all the time we have for that conversation. I also quizzed him about ROA, and he said that the aspiration is to maintain that 1.5% or be very close to that 1.5% in terms of ROA, and the credit cost will remain at around 20 bips, which is, frankly, as low as it can get. So, but a very interesting conversation, and if they're able to pull this off, it's also a very, very interesting company to look at. So look at it closely, do analyze all the commentary coming out of that one. But for now, on KYC, that's all the time we have. Stay tuned to NDTV Profit. More action on the other side.